It is 2021, so let's talk about our economy chances this year. And we do know the number that we're working with. The Treasury is telling us that it's possible for us to go all the way to 5.2%. Last year, we did see a flurry of numbers that we were sort of thrown to. We saw 6.6 at the beginning of the year. We went all the way to negative 5.7% contraction on GDP. So now 2021 is sort of viewed as a year that we're going to come back to that. How possible is it in 2021? This morning, we are joined by Rodney Omukhulu. He is head of research. So let me just proper investment analyst, at Cytonn Investments, and Churchill Ogutu, head of research, Genghis Capital, as we put that conversation into a proper spotlight. All right, let's get into it therefore. Kenya's economic outlook for 2021 is expected to remain neutral, with a growth expected to come in at 3.9% to 4.1%. Now, this supported by improved business sentiment following the easing of restrictions meant to curb the spread of the COVID-19 pandemic. According to Cytonn Investments' latest economic outlook report, the key downside to this growth shall be any delays in procurement, distribution, and administration of the vaccine. According to Rodney Omukhulu, an investment analyst at Cytonn, stable growth of the agricultural sector following the favorable weather experience in the fourth quarter of 2020 and the reopening of the economies of some of Kenya's major trading partners will also aid in economic recovery this year. Meanwhile, a positive performance is expected in the land sector, with the overall outlook for the real estate sector being neutral. Now, this is attributable to the sluggish performance in the wake of a tough economic environment amid the COVID-19 pandemic, which has resulted in reduced disposable income, thus dwindling transaction volumes and scaling down of operations by some business. Now, this has in turn affected the uptake of office and retail space. That's where we are. Let's take a look at where we are in terms of that GDP growth and the comparison that we have for you. Let's therefore take a look at our annual GDP growth rate. And if you look at that data that we have for you, therefore, you're going to see at exactly where we are and what could be our that's real estate. Let's look at where we are in terms of annual GDP growth. Rishi, you could give us that data. We're not looking at, yes, that's where we are from 2017 to 2019. And we do know what we recorded again in 2020. Let's therefore look at our quarterly GDP growth as well, all the way up to where we are. The biggest talking point is in 2020 again, where we had that negative 5.7% contraction in our GDP, and we do know exactly where we recorded. Now, with the talking point being that we might be rebounding back. Rodney is with us this morning. Rodney, let me ask you this question. Is 3.9 and 4.1 being too optimistic?
First of all, thank you for having me. And with regards to whether 3.9 or 4.1 is too optimistic, I'd say there are various factors that are driving this expected growth. And the way I'd want you to look at it is consider 2020 being a situation where we have the virus. It's had significant effects where you've seen dips of 5.7, that's Q2 2020.
Yes.
This is the lowest we've ever got to since 2002, sorry. Considering what we've been going through, the virus, reopening of economies, we've seen an improvement over the second half of the year. And we believe that the economy being majorly driven by agriculture, which has somewhat been stable through the year, we'll see that resilience come 2021. And also, given the poor business conditions seen back in 2020, we are seeing this pick up when you look at also the PMI figures, which improved quite significantly. Fourth, I believe this is the general trend or where we see the country moving. So based on our modeling, our expectations for 2021 came in at that range of 3.9, 4.1, which we believe is optimistic, but within the range.
Let me bring in Churchill on that. William, I'm going to come back to you on that, on what the real indicators are really for our economy chances this year. Churchill, I'm going to ask you the same question. too optimistic? And I'm coming from this point. I mean, we're still within the coronavirus pandemic. It's not like we started 2021 and all of a sudden we don't have the pandemic. And we look at that data, especially the way now we're looking at it. Other economies are talking about the numbers of vaccinations in the country. We're still talking about the number of fatalities and infections. So are we still not in it?
Thanks for the question. Looking at where we were last year, 2020, of course, it was COVID-19 fallout, whereby there was the lockdowns, in particular during the second quarter period. That's where we saw the dip in negative, dip of negative 5.7% growth
Yes.
in that particular period. Of course, the other leading economic indicators have been quite promising, but those leading economic indicators that so far has been put out, you find that they're skewed into particular sector, be it on the agriculture or be it on some of the export side. But we are still at a point whereby we are into the year 2021, but you haven't seen the 3Q numbers. Ideally, by the start of this year, we should have seen the 3Q numbers. So based on that, it's still cloudy how 2020 was in terms of the growth of last year and getting into 2021. But having said that, of course, there's this positive sentiment that with the rollout of vaccines, it will be able to at least ensure that there's an easing of the containment measures as they are not only in Kenya but across the globe. But there's one thing having the supply of the vaccines, and there's another thing of demand. People now voluntarily going to get themselves vaccinated, or even it could be things to do with the cost of that vaccines or any other factors that could even dictate the demand. Locally, I think we are at a point whereby people have shrugged their heads. They are saying that COVID is behind us, even the kind of people letting down their guard in terms of observing or adhering to the social distancing norms that have been put by the government.
Yes.
So all this is pointing to the fact that perhaps the demand of the vaccine might not be as outsized as is expected, or as we were at some point last year, November. So probably that vaccine perhaps is pretty much overplayed if we look at it, the context that we are right in. But having said that, there's still some positive sentiment. We can't throw away that fact, and that could also, comparing with 2020 and 2021, there's that expectation that the growth this year might be better than 2020.
Pretty much. Rodney, this is for you, therefore. I mean, let's talk about what have been our biggest contributors to our GDP over time. And Rodney, well, your report highlights that, and I want to bring you back to exactly what it says. Good. Tourism, as we do not of it, we're still expecting for when we're going to see that rebound. So in terms of its contribution again in 2021, it's neither here nor there. Well, that's why we're saying, well, hopefully things are going to turn around and then we start seeing that rebound as well. Let's talk about the corporate sector, Rodney. That's exactly where we saw a lot of massive job losses as well. So in terms of it rebounding this year, again, it's a wait and see. So is that not where we're coming from, saying that, well, despite the positive sentiment in the economy, it might not get to where we anticipate it to be?
To be honest, it's what you say is quite relevant, but when you look at corporate performance,
yes,
job losses are very significant, yes, but the way these businesses have been performing in
yes.
2020 was really under a lot of pressure, where you find that the whole country is under lockdown. Restaurants are closed, you have your bars are closed, hotels are closing down. So when you look at 2021 and the way the general economy is opening up,
yes,
where guys are going back to work, so you find that households are spending a bit more, so you're buying a bit more in the house. Our children are back in school, so we expect education also to improve significantly in 2021, considering 2020, as of March, learning stopped. So for us, the growth will be contributed to by various sectors. So growth in each, although tourism will have a slower growth compared to the rest, just given the slow opening of global economies generally, where our main or our bulk of tourists come from.
Pretty much. Churchill, let me get you to weigh in on this as well. We start 2021, and then you spoke about positive sentiment, but I want to point you out to some things that we've actually seen as we start 2021 when it comes to taxation and tax in the country. The taxman has introduced new measures around taxation, and we have gone back to pre-COVID-19 taxation regime. Do you think that this is going to also have a bigger hit on the way that the economy is going to perform this year? Because it's as if we're saying, well, we got to get back. But it's not as if things are back to normal in January 2021, are they, Churchill?
Absolutely. I'm agreeing with this sentiments. And actually, we are looking at a point whereby we are not even back to pre-COVID level in terms of taxation. We are even, those taxation measures are actually higher than where we were pre-COVID levels.
Yes.
We are at a point whereby some of the tax bans have been completely eliminated, 15% and 20%. So it's just telling us that perhaps even the government coffers are quite dry, running dry. So there's that emphasis that the government at this particular point in time that they need to rev up their tax revenues measures. But having said that, is it the right time to introduce those taxes? I believe not. It's still premature, and it's still a premature. It was a premature reversal in my view, the timing. And looking at some other economies, case in point, US, they have had series of acts last year to stimulate the economy to the close of $3.7 trillion. That's roughly 17% of their GDP. And right now, even with the incoming Biden administration, we are looking at an additional $1.9 trillion. So it's just telling us that even in the best of economies, people are not yet out of the woods. So back to Kenya's context, those reintroduction of those pre-COVID, as you put it, were premature, and also some of the other taxation measures, case in point, introduction of minimum tax, 1% of the gross turnover for some of those companies which are in loss-making entities. That is just, in this current business cycle, I don't think it bodes well.
Pretty much. Churchill, thank you for that. I just want us to jump on to the next issue that we have for you, gentlemen, this morning, because analysts now predict the cost of loans could jump by 1.5% if the Central Bank of Kenya, CBK, yields to pressure from banks to allow them raise lending costs, citing market forces that have been heavily contributed to by the COVID-19 pandemic. Now, loan prices have remained relatively low, recording a historic drop at the end of 2020, despite Kenya scrapping legal controls of credit charges on November 7th, 2019, with a regulator blocking bids by banks to raise rates. Analysts at Genghis Capital now say that the regulator is likely to pave way for the approval of new loan pricing formulas this year that will give direction of interest rates on new credit. Now, Genghis Capital senior analyst Churchill Ogutu says, and I quote, that the sector had expected approvals for their models at the tail end of last year, and we expect that the CBK is likely to give the thumbs up from this year to support private sector credit growth, which has in recent years lingered in the single digits. Now, the risk-based pricing models are envisaged to increase customer loans between rates by 100 to 150 basis points. Now, Churchill is however adamant that the new rates are likely to apply to new loans rather than banks making adjustments to existing loan portfolios. Good thing is that we have him here this morning. Rodney, I would like to start with you, but because that's a direct quote from Churchill, let me take you on that, Churchill. The regulator has been blamed for the entire of 2019 to 2020 as well. In fact, immediately after the scrapping of the cap on interest rates, that he took a customer approach rather than an industry approach. Good. Now let's go back to the headlines again. Since 2019, even during the entire of this COVID-19 pandemic, Churchill, they said the industry is quite stable. But you're adamant that this time round, especially in 2021, is going to fall to that pressure. Is he? And what are the indicators?
Thanks, Elijah. Looking at the context where we are coming from, private sector credit growth, that is as at November 2020, was at 8.2%.
Yes.
It may look elevated, but looking at the net private, looking at the net credit that has been extended to the private sector between this whole COVID period, that is between April up until November, we are seeing it's around 151.7 billion in terms of the net private sector credit. And comparing that to the same period in 2019, it's around 156.7 billion that was extended to the private sector. So two things are coming out. The first one is that in this last year, we had 150 basis points reduction in the CBR. Ideally, in a normal environment, that should be supportive or constructive to lending to the private sector.
Yes.
The previous year, we were during that period between April to November 2019, we were still under the upper rate cap was still in place before it was now eventually removed come November 2019. But still there was that, in as much as the banks themselves were still not yet risk on in lending, they were still extending credit. So that takes us to the second point, that there's still been some cautiousness amongst banks in terms of extending credit. Of course, the biggest factor here is COVID-19 pandemic, which has brought a whole cloud of uncertainty. But having said that, you could see that with the reduction in the CBR, the intended consequence of that should have been robust credit mediation to the private sector. That hasn't been the case. In fact, we've seen growth in government securities during that period between April to November, a net increase of 294 billion. So there's been the banks have been quite cautious. They've been looking at lending to the government securities. So right now, because even looking at the average lending rate in the banking sector, this is as a October last year, it was around 11.9%.
Yes.
So we are still at a point whereby we still have a cap. Previously, the cap was CBR plus 4% increase. So if you look at where the CBR currently is at 4%. So you're still roughly within this an invisible cap in the environment by the banks in terms of lending, and of course they can't be able to price risk adequately. Hence, at least with the approval of the risk-based pricing model to the banks from the regulator, it will be able to unleash that robust private sector credit mediation to the private sector.
Churchill, I'm going to come back to you on that because there are a lot of talking points again, even as we talk about that the regulator might actually now fall to that pressure. Rodney, let me bring you in on this. I spoke to you last year and I told you, well, if you go by what the banking industry is going through right now, I mean, every bank did record massive reduction in profits, and they were also saying that the only thing that we did this year or last year was providing for those loans that we gave out during that period, despite the CBR getting reduced. Now, I asked you, Rodney, that were we going to get ready for expensive credit? And I'm going to ask you that same question as well. Are we likely now to say that 2021 is the time that the economy is going to experience expensive credit?
Well, with regards to that question, I believe it's debatable.
Yes.
Just given, I'd say I concur with what Churchill says, where we seem to have an invisible cap.
Yes.
You have the removal of the rate cap, but this effect isn't being felt in businesses. You expect credit growth to go to double digits, but through the year it's been 7, 8, 6. So I'd say the effect of this onward lending isn't being felt in the industry.
Yes.
And given the discussions that are ongoing between banks and the regulator in terms of that pricing of loans, I'd say, considering also the status of the economy, it will take some time before we get to that point.
Yes.
It's a possibility that loans will be expensive, given also the risks that are currently in the economy with COVID around. So I'd say I'd lean on the more expensive side, but we are still yet to see a clear picture of how this will pan out.
Pretty much. All right, Churchill, let me get back to you on that as well. I mean, somebody's going to ask you the question, Churchill, that, well, we spoke about about how we got done away with the cap on interest rates. Fine, everybody did celebrate, and even the banking industry did celebrate that for the very first time now, they're going to have this, I would say, room to properly price their products. But the announcement that we didn't even get from the Bankers Association is that times for expensive credit were well done with in the economy. They said, forget the 20%, forget the 18%, forget the 17%. We are still going to operate as close as we can to what the CBR really indicates, even before the cap on interest rates. Why didn't we see a robust movement to sort of, I would say, an expression of each bank to properly price their products?
Yes. Remember during that period, with the removal of the upper ceiling of the rate cap, there's that celebration that now banks can now start properly pricing their credits.
Yes.
But I remember there was one bank, there was a bit of some censure that came out because there was that, there was like somehow a move towards those Wild West trades of 20%. And based on that censure of one of the banks, so most banks now were hesitant to now start to properly price their credit. So hence now the risk-based pricing models that they have been putting to the Apex Bank, at least to have them to ensure that there's a proper pricing of risk. That hasn't yet panned out. Just looking at even the way the private sector credit has been in the last 12, 15 months or so.
Yes.
So going forward, I think this also brings to this other issue that even some of the incentives, some of the initiatives that the government is trying to bring on board. Last month, we saw the SME credit guarantee scheme, at least to support this huge critical player of the economy, the SME. But this is whereby now the government could stand in the event that an SME may not be able to repay back their loans that they have taken it. At least there's a percentage that Treasury and some of the banks that are into this place have come in to the SME credit guarantee scheme might be able to offer their backstop. But having said that, I think the sequence of things should be like in place, in as much as there's a SME credit guarantee scheme, we need to ensure that even the loans in the first place are extended to the SME segment. Right now in the environment, that is not the case. In as much as we have this SME credit guarantee scheme, we've had 2 years ago there was a Stawi product which was now meant to extend credit to the micro lenders of the economy. I don't know how far. It could be me who has not had anything coming out from Stawi in the last, say, 1 month. I haven't had anything.
Me too, Churchill. I've not actually had it since it was launched.
So that makes the two of us.
And the president attended the launch, if you remember.
Even the city governor attended the launch. So we have not seen much traction in some of these measures to extend credit to the micro credit segment of the economy. So I'm still cautious, even with the viability of this SME credit guarantee scheme, but in the event that banks might be able to properly price risk, we may not get back to those 20% levels, but
yes,
at least they might be able to have some latitude in pricing credit, and then it could make sense for that SME credit guarantee scheme to be quite viable, in my view.
Pretty much, we're coming slowly to the end of this conversation this morning. Wow, conversation this morning. I would like to take a short break, but Rodney, once we come back, I mean, I hear from you, you're saying it's not clear. Churchill is also saying, well, the CBK might fall to pressure from these other banks now to give them their way to sort of properly price their products. Question being, gentlemen, is the banking industry, as we do know of it, under Governor Njoroge, highly regulated? Because some CEOs have been grumbling about that. Once we come from this short break, you're still watching Metropole's Business AM. My name is Simba Elijah Charles Kiage. Get involved 2146 at Metropole TVKE across all your social media platforms once we come back.